we're going to go get that free money in a high yield savings account. We're going to, of course, make sure it's FDIC insured and it's probably a bank we've heard of, but it's going to earn probably 5-10x than what my normal savings account is at a big institution.
Hey, Nick.
Scott, good to see you. How you doing?
You too, man. Welcome back.
It has been a little bit of time. I'm excited to dive in today, and we got a great topic.
It has, yeah. And to those who maybe missed us for a little period of time there, we were on a bit of a break. I got to take the family to Tahiti, which was amazing. And now we're back.
Yeah, I was going to say, you got a little tan to you?
It's as tan as this white guy gets. Yeah, right here. If you're watching it on a YouTube clip, you'll see. But today, I thought we were kicking around ideas for the show today, and I think we come back to a topic that we have people ask us all the time, and it's just a good foundational question, and that is like, where should I be saving, and kind of what's the order to think about saving. Mm-hmm. So I think that's a good one for today, and yeah, let's take it away.
Awesome. Yeah, I like the word order, hierarchy. We get the question all the time, and we'll dive into it in today's podcast, depending on where you find yourself as you're listening. If you're in your 30s and 40s, or if you're approaching retirement, the order is still going to be really important. It's going to apply to everybody. Yeah. But then how we begin to view it as we get closer to retirement, or what our specific goal is, there's going to be some flexibility. But I think we've said it before, you don't need to have a reason to save. And so there's going to be a couple things that we want to make sure we check off along the way. But, we're going to touch on today, where do we want to start first, and what things should we achieve before we move on to the next one?
Absolutely. And the first one isn't really so much saving as it is I think of it as like having an insurance policy on life. And that's really just making sure that you have an emergency fund or a cash reserve. Mm-hmm. And so the question is, like, do you have one? And if you have one, how full is that cash reserve? And is it the appropriate amount for you?
Yeah. And I like to say, and this is very vague, very general, rule of thumb here. If there's two incomes in the household, great. We could lighten up that reserve and keep it closer to 3 months if we have, biweekly paychecks coming in from two different sources. But, if it's a one source of income type of household, maybe we need closer to 6 and we have a bigger reserve. And so those are rules of thumb, and then, the second thing there is it's what you personally feel comfortable with. I like having a bigger number. It makes, me and my family feel a little safer because things will happen. We're going to dig into it, whether it's, it's time we go to the mechanic and it's not just an oil change this time. I'm holding my breath, and that's what it's there for.
Yeah, absolutely. And to your point, that cash reserve, like I think of it, if I think of an extreme, if you have 2 tenured professors,
okay,
who essentially can't be fired from their university and are going to get that income for life and are going to have a pension in the future, they might not need much of an emergency reserve. Mm-hmm. Right? Like they're always going to have cash coming in. And then if you have a small business owner who's a cyclical business. So when the boom and bust of the economy happens, when the boom happens, they make tons of money, but when the bust happens, they go dry. Mm-hmm. Well, man, you're going to want a really large reserve there. Mm-hmm. And then there's everything in between. And to your point, there's how do you feel about it? And how does your spouse feel about it, by the way?
2 different numbers, depending on who you ask. Yep.
Yeah, and that'll help you figure out what to have. But just make sure you have it, and then it's full. And if it's not, you'd want to be allocating some portion. I'm not going to say all, but some portion of your savings to that emergency fund to fill it up.
Yeah.
Right. And the reason I'd say not all is because the next thing we go to is like, where's the free money? And the free money that most people know about. And sometimes people will even say, when I ask the question, like, are you maxing out your 401k? They'll be like, yes. Mm-hmm. And then I'll go check. And what they're doing is they're maxing out their company match, the free income. So if you make $100,000 of income and you get a 4% match, right? You put in 4% or $4,000. The company matches $4,000. So now you're up to $8,000 of savings at 8% of your salary. Really good. But you're not maxing out the 401k. You're maxing out the match. But that is the next place I would look, because that's essentially saying like, hey, are you getting this free money that exists? This is easy for you to get, and you won't really notice the difference on your paycheck.
Whether it's the 401k, when I think about free money too, one of the things I commonly see, and I forget that this isn't always something that, general knowledge when it comes to free money, but I love using a high yield savings account. I don't know about you.
Mm-hmm.
For our family, we kind of figure out what is the money we need to keep in our primary bank account to table back just to savings real quick. And anything else, maybe we'll say 1 or 2 months of emergency expenses and income and savings, and everything else, we're going to go get that free money in a high yield savings account. We're going to, of course, make sure it's FDIC insured and it's probably a bank we've heard of, but it's going to earn probably 5-10x than what my normal savings account is at a big institution.
Mm-hmm.
And so that's just another great way that we look at it, in getting that free money in addition to, our 401k.
Yeah, that's a great point. And I think that kind of goes back to cash reserve. We didn't even mention it there because it was already like so ingrained in my brain already that all cash reserves should either be in a U.S. money market account, basically sitting in T-bills all the time, or high yield savings account at a bank, because you get that 3-4% on your money. And especially for those who need to have more of a reserve, it's even more important to have it sitting there. So you're not losing out to inflation. So yeah, absolutely. Totally agree with that.
Yeah, and that company match, it's like getting a raise every single year in a lot of ways, where we're getting more than just what we get on our salary. And so if it's, to your point, $100,000 and we get the 4% match, great. Hey, thank you so much, Mr. and Mrs. Employer, for the $4,000.
Absolutely, really it compounds your growth because you're compounding your savings.
Mm-hmm. Oh,
right? It's so important. Oh, absolutely. The next thing I would think about, if you have a high deductible savings account, or high premium plan, if with your insurer, and you have an HSA eligible, fill up that HSA account. That's like the triple tax savings, right? You can put in the money, you don't pay taxes. You can let it grow, you don't pay taxes. You take it out for anything medical, you don't pay taxes. So it's a really great place to put money. Now, the question there is for whether or not it's savings. If you're using it to grow the HSA to be a part of your retirement strategy, which I think is actually a great idea, because if you take the funds out, not needing them for medical, it's just like an IRA distribution. Mm-hmm. And if you use it for actual health expenses in retirement, it's tax-free. So it's treated more like a Roth then, which is awesome. What a wonderful place.
Right. And so many people, they'll come to us after the 401k match, right? That's the kind of the table stakes. Let me get that first. I got my emergency savings. And they'll say, I'm going to go into my IRA or my Roth IRA next. But I love this kind of caveat or hierarchy of saying, well, hold on, let's go through the HSA, because I think the point that you touched on of the triple tax saving is often an overlooked part. And I also look at it too, for depending on where you fall with how much you make, for a high income family, you get that deductible. You get that tax deduction that you otherwise wouldn't get in the IRA or the Roth IRA, right? And then we kind of have this magic power in retirement where, to your point, if we use it for qualified medical expenses, well, we have this Roth account. Right. If we don't need it, right? If we end up saying, hey, we don't need this, it's not just earmarked for health and for medical expenses. It's now just an IRA, and we're getting that deduction along the way. So I love, that's kind of a hidden one that I don't think a lot of people think of first, because we commonly think of it just as, well, this is just going to pay for health insurance, but I need to be saving for retirement.
Absolutely. You reminded me of a little asterisk, because it is deductible for federal tax returns. And then it's dependent. For most states, it is. For California, sadly, it's not. But there still is a tax deduction that's happening, and the money getting utilized in the future. You don't have to go ahead and pay the taxes in the future. So that's a good thing. Then I think from there, you and I would agree that we would go next back to probably the 401k and go like, yeah, man, let's get this pre-tax, let's get this retirement fund set so we can set it and forget it. Absolutely. I think the question to ask yourself, though, is look at your tax bracket to ask yourself, should I do this with Roth contributions, or should I do this with pre-tax contributions? So am I paying the tax today, or am I going to pay the tax in the future?
And where do you usually see that irons out? Right around like the anything north, like what's the equator there? Is that north of the 24-32 line?
I mean, that's to me where I'm looking at it going like, if you're in the 10, 12, 15, those are all Roth to me.
Yeah.
You start getting the 22 to 24 range. Yeah, maybe
Splitting
you
hairs.
probably want
Yeah.
some blend of the two.
Right.
You get above that, it probably makes sense to go pre-tax.
Absolutely.
Obviously, the highest bracket, it definitely makes sense to go pre-tax.
Yeah. And then and I can't remember off the top of my head, it seems like they change every single year with the adjustments to inflation or different tax bills. But what is the limit at right now? Like 30,500, somewhere in there. For what you're able to.
I don't have it in front of
I
me.
used to have
Good question.
27 seared into my memory for years, so I think it's somewhere around 30,500. I say all that.
23,500 with a $7,500 catch up for 50 and over, so 31,000.
Okay.
Yeah.
23.
Except now there's a new provision for like people for, I think it's 60, 61, 62. They can do this like even funkier catch up where they can increase that amount.
Super.
We're not going to dive into that here.
Yeah. I bring up those limits because a lot of times, we'll say, okay, well then what's next? And it's okay, well, maybe we can go into a Roth or, an IRA, and those are smaller numbers, but there's something out there called a backdoor Roth, or this mega backdoor Roth. And, what a lot of people don't realize is, our 401ks are actually consistent of two different buckets.
Yep.
A bucket that you fill up by putting in your money through payroll contributions, every 2 weeks or if you get paid monthly every month as your employee, but then your employer, where you get your match from, that bucket has the capacity to get filled up pretty significantly, right?
Yeah, and so the rule there is $70,000 total in the 401k if you're under the age of 50. So if you put away $23,500 and then you get a match, right? So you're going to get some match from your employer because it's everything combined, employee and employer. If there's no match for the employer, you put away the 23.5. You could do a mega backdoor Roth is what we call it in our little geeky industry, $46,500. So you would literally you would say, hey, once I've hit that max number for my 401k, I keep putting money away. You would actually probably even double the amount you're putting away or something to get you to that number. And then you either have to call the group that services the plan for you to request. They'll put the money in what's called an after-tax contribution, but you have to request what's called an in-service rollover or in-service conversion, Roth conversion. And they literally take it from this after-tax bucket and they convert it to your Roth bucket inside the plan. Some providers, Fidelity, for instance, a lot of the plans on Fidelity, they allow you to set it up automatically now.
That's really nice. And so you have up to that threshold, that's $70,000. So that's a nice pickup if you have the income to be able to support that. It's much bigger than just the 23.5 or 30,000 and change if you're over 50, that you may not know that you have the ability to.
Absolutely. Yeah. And that does tie back into that idea of the mega backdoor Roths kind of after we've maxed out the 401k. And then you could also just do what's called a backdoor Roth, which is just $7,000 this year. So $7,000 goes in an IRA account. It's a non-deductible IRA contribution. I convert it to my Roth. Now it gets to grow tax-free for the rest of my life. Big caveat here, a little pro tip, make sure you have no other IRA assets in existence when you do that. If you do, you will be, you'll have to deal with what's called the pro rata rule. The government looks at Nick's assets, and Nick put $7,000 in an IRA and converted it to Roth, and he thinks he's really winning. And he forgets that he has $93,000 in an old IRA somewhere else. So now when he goes and does that conversion form, he thinks he owes no taxes, but the IRS is actually going to say, actually, you owe 93%. Because it was 100, 93 plus 7's 100, so 93% pro rata tax on that conversion because you had other IRA assets. If those IRA assets, that 97 grand, was simply taken and moved into his 401k plan at work, he wouldn't have that problem. So it's just something to be mindful of.
And this is where to your point, being mindful of understanding what the bigger picture is at play, what we're trying to accomplish, and then where best next to save, and figuring out, okay, hey, if I want to go this backdoor route, should I do it with my employer first through the mega backdoor? If we've already accomplished that, and to Scott's point with his analogy or example, if we already have an IRA balance, but we want to do that backdoor Roth for $7,000, let's figure out first if our plan allows us to maybe get rid of that IRA, sweep it into the plan, clear things out, because otherwise we're kind of losing the potency of the ability to do that backdoor Roth. So a lot of things at play here. Now, there is one account that we haven't mentioned yet that really could, if I want to argue, go anywhere from, I think, if we're looking at 6 or 7 different places that we want to save, I think this could kind of slot in at any point after maybe the HSA. And you've already gotten your match. Maybe you max out the 401k, but it's the brokerage account, right? I love this account personally when we start working with higher income earners or retirees getting closer to that finish line, because the brokerage account's got it. Remember, it has no limits to it. You can contribute as much as you want to it, but it also has no handcuffs on it, meaning I don't have to wait until I'm 55 or 59 and a half to take the money out. And then it's also taxed pretty favorably at capital gains rates, which are, a lot friendlier than ordinary income, right?
Yep, you're making really good points. So everything that we've talked about to this point, whether it's a 401k, a 403b, a TSP plan, right, retirement account, or a Roth account or an HSA, all of those have tax wrappers. They basically have tax laws that make them follow a certain set of rules. A brokerage account does not. You can hold it in your individual name. You can hold it as a couple. And we see that often, or we see it held often in trust when clients form a trust for themselves. And then you can buy and sell things inside of it. And so long as you hold assets for more than a year, you get preferential tax treatment, which is really nice. But yeah, to your point, it's a lovely account to have. And I actually think when you go back and look at the bigger picture, I think one of the things you always have to ask yourself when you're looking at a saving strategy is, well, what's your main goal? Right? Because if someone comes to me and their main goal is, I really don't like the work that I'm doing. I really want to start my next career as soon as possible, and I'm going to need funds to help me do it. Well, then we're probably not going to maximize savings in 401ks and Roth accounts.
Right.
We're probably going to maximize savings in a brokerage account because we have access to it, to your point, right away. Right. Whereas if someone else comes and they go, I love the work that I do, I want to do it for the rest of my life. Well, great. Max out your 401ks and stuff and keep building up your traditional. If clients can come, the ideal, in my mind, the ideal asset allocation or allocation of location of assets, not knowing where we need to have assets with future taxes, is really a third, and a third between Roth, IRA, and brokerage, because it gives us the freedom of tax-free, pre-tax, and brokerage. So it's like we can really change any strategy and get it to work for us. If we have a fully funded 401k that comes to us for retirement, there's really little we can do to save on taxes.
Yeah, you use the word freedom. I use the word flexibility. A lot of times in my practice, we're working with clients that are in their 50s to that point of like, hey, I think I'm done. I think in the next couple of years, we're looking to retirement. And we start looking at, well, if we have the third approach, man, does that open up so many different avenues to be able to say, oh, well, now what about healthcare? Well, if we're taking it from our distributions, that is, from a brokerage account, we could keep our income really, really low. All of a sudden, healthcare gets a lot more affordable. We're taking it from an IRA, we just spiked up our income, and now we're in a different tax rate. And so oftentimes I see clients or prospective clients that'll come to us that haven't really had a plan or a strategy amongst savings. It is, let me just be a good saver. I'm going to put it in my 401k and my IRA, put my head down and just work and earn and save and accumulate.
Right.
And then they look up in their mid 50s and they go, oh, this is going to be a really big tax bill because every dollar coming out now is ordinary income. Should have thought ahead of this. And so that idea of just continuing to allow savings to be the consistent, and that's a great habit to be into, right? But now a third, and just being able to have different buckets available to create that freedom, that flexibility. And it ties back to, what is the purpose of the money? What's the end goal? What are we trying to do?
Absolutely. I fully agree. And it also gives you freedom when you do hit retirement to do other things. Like one of the things we'll look at doing, you'll hear about every once in a while, are we're talking about in-service Roth conversions for converting income now while you're working. But another thing we can look at is we can go like, hey, right when you retire, to Nick's point, and you were touching on this thing called IRMA, which you guys may not have heard of before, but it's basically saying like the government says, hey, everyone's going to be on Medicare and everyone's going to have a premium to pay. And the premium that you pay is based off of the previous 2 years' tax return. So if you're in a really low tax bracket, you pay a little, and the higher you go up in tax bracket, the higher that premium goes. And so managing that can mean that thousands of dollars, tens of thousands of dollars in retirement.
Right.
But another thing that you can look at is you can just look at, well, hey, what about tax rates all throughout retirement? So when I retire at 55 or 60, I'm not going to have to take from my IRA until 73 now, maybe 75, right? With the newer rules. And so the question is like, hey, if that keeps doubling in value, that IRA, how big is that sucker going to get? Right. So would it make sense for us to take some of it out in the years when we have very, very little income and fill up the lower tax brackets? And if we have taxable money to pay for that tax, that's really great. Right? So that we can go ahead and smooth out how much we're going to pay in taxes over our lifetime.
And that's the phrase that we use with our clients all the time when it comes to lowering our taxes. So many people have ingrained that, I want the big refund today. I want to pay less in taxes. But part of our job is to challenge them to say, how do we start thinking about your lifetime tax bill?
Yes.
If you're in your 40s or 50s and listening to this, we're starting to think now, being great savers and investors and accumulators, what are the steps that I could begin to be doing today to lower that lifetime tax bill? That's a healthy exercise to be able to go through.
Hey, the little man's crying. That's okay. That's life, man.
That's right. I told him we're saving for college instead of a vacation. He wasn't very happy about that.
Briggs doesn't mind. Everyone meet Briggs.
Yes, the little man, 4 months old today. So
yeah. Congratulations.
Thank you. Sleep looks very different these days, my friend, as I'm sure you know, are well aware of. But yeah, we look at, let's skate to where the puck's going. And so when we have this game plan for what is this money for, we then begin to say, okay, well, and I could sit here and say it's pretty difficult to figure out our lives a year from now, 2 years from now, 5 or 10 years from now. It gets a little blurry, but trying to at least figure out where do we think we're going to spend. And if we have a game plan around where we're going to pull that first dollar out from, it really goes a long way. And so that's a great challenge and an exercise to start thinking about today is, where are the buckets, or the accounts rather, that we're saving to today? And can I space that out potentially to give myself that more freedom and flexibility when it comes to retirement or whatever that goal is going to be?
Yeah, I think that's a great way to end it. So I think the key takeaways for me, for what we've talked about today, if I were you guys at home, I would look at that list of things, the emergency fund. Am I hitting my 401k? Do I have an HSA? Am I contributing? Am I maxing out my 401k? Is it to Roth? Is it to regular? Am I doing a backdoor Roth or a mega backdoor Roth? Does that make sense for me? What am I saving to a brokerage account? And then go look and make, are these the right things for me? And then is the situation that I have, is it helping create freedom and flexibility on my balance sheet?
Yes.
And if it's not, if you're heavily weighted to the 401k right now and you have nothing anywhere else, you might want to think about changing something for a period of time to start creating more freedom and flexibility.
There you go.
Yeah. Well, thanks, man.
Of course, Scott. Such a good episode. Keep saving.
Good seeing you.
Likewise.